This is the financial analysis of Pepsi Company and the Coca-Cola Company presented by myself, Caitlin Rodriguez.
And I am Lorenzo Felix.
So these are the top 10 owners of Pepsi and Coca-Cola, and they actually both share 7 of the same shareholders. Do our shareholders care about our cost of capital? Yes, our shareholders care about the cost of capital because it is a useful financial tool that is able to assess projects and investments with the intent to limit costs. It calculates the investment opportunity cost and is able to maximize potential investments in the process. And once an evaluation is made, businesses can make better decisions on their capital investment in order to maximize their profit. What is our cost of debt financing? So the pre-tax cost of debt for Coca-Cola is 2.77%, and for Pepsi it is 3.07%. The after-tax for cost of debt for Coca-Cola is 2.19%, and for Pepsi it is 2.40%. So what is our cost of equity financing? For Pepsi, the cost of equity is 5.7%, and for Coca-Cola, it is 6.42%. So we will use these values to determine the weighted average cost of capital for our companies. So the debt ratio for Pepsi is 14.35%, and for Coca-Cola is 20.15%. The equity ratio for Pepsi is 85.65%, and for Coca-Cola it is 79.85%. And both have a preferred stock ratio of 0. The WACC for the Coca-Cola Company is 5.87%, and for Pepsi it is 5.09%.
All right, so could we lower this by changing our capital structure? And so one way to lower WACC is to exchange debt financing for equity financing. And we'll go a little more into detail about this in our next slides. So how would a financial restructuring affect the value of our company? So increasing Coca-Cola's debt ratio up to 20% would be their optimal debt ratio, and that would increase their enterprise value up to 297 billion and 183 million. And so then bringing down Pepsi's debt ratio to the optimal value of 10% gives the company a bond rating of AAA, but their enterprise value would decrease from what it's currently at to 302 billion and 439 million. And so would more debt create unnecessary risk? And so if the Coca-Cola Company or Pepsi were to take on more debt, then there would be multiple disadvantages and advantages of this. And so the advantages of carrying more debt would be that the tax rate would decrease if the companies were to take on more debt. The beta will increase with a higher debt ratio, and Coca-Cola Company's value would actually increase if they were to raise the debt ratio up to 20% at the optimal ratio. And the disadvantages of carrying more debt would be that the company's bond rating would decrease from what it's currently at. Any increase to Coca-Cola's debt ratio above 20% would decrease their enterprise value. There's also a decreased risk with a higher debt ratio, and carrying more debt may be negative for PepsiCo due to the fact that their current debt ratio is already higher than optimal. And so what does our competition do? And so although the companies that we've compared to Coca-Cola and Pepsi are a lot smaller, being Monster Beverage and Keurig Dr. Pepper, Monster Beverage having 44.3 billion market cap and Dr. Pepper having 53.76 billion market cap, they still have very similar companies, so we can compare them. And so both Pepsi and Coca-Cola seem to have their assets better balanced than their competitors that we've compared them with. But when we look at shareholders' equity, we can see that Monster's Energy seems to have the highest percentage when compared to everyone else, while PepsiCo has the lowest out of all 4 companies. And is our stock fairly priced? And so while we were doing the analysis based on financial metric or the PE ratio, we concluded that the Coca-Cola Company is undervalued when compared to the current price of 59.21. And this the current price is as of 12/31/21. And for PepsiCo, we've concluded that the current price of the stock is overvalued when compared to the intrinsic value of 170.57. Thank you.